Welcome back to the Small Business Mindset. One of the reasons I started the podcast in the first place a number of years ago is because I was having conversations every single day with my clients and colleagues and people in the community that didn't necessarily have to do with real estate. I'm a commercial real estate broker and I own my own firm in Kansas. And what I was realizing is that sometimes small business owners would come to me and they'd start with the real estate first. And that's not always the place they needed to start. Maybe they needed to connect with a CPA first to get their business entity established. Or maybe they need to understand their financials a little better, or what have you, business plan, all that kind of stuff. One of the things that I've heard over and over again from my clients, especially in real estate, and one of the premises for this podcast is, how do I get into investing in actual property, income property that creates a passive income for myself and my family and my business? Now, I'm not saying you have to have a degree in business or finance. I sure don't. But I do have a background in banking, so do understand a lot of the lending parameters that go into it. But more importantly, I'm a property investor myself, and I work within the industry. And so I wanted to have a little bit of a teaching moment today. And if you are listening to me through your device on your normal podcast platform, jump onto my YouTube channel because there are some visuals I'm going to go through today. I'm going to try to describe them as best as I can as I walk through the examples of how to look at properties to invest in that make sense for you as a property investor and to create that passive income. The thing I love the most about being a small business owner myself is that I get a chance to create different lanes of income. One is through my real estate brokerage, so my full-time job, my paid job, but I also have property management, and then I also have property investing. So these are different lanes of different income streams that I've created for myself and my business that I want to share with you. So I'm going to give you an example, and I'm going to try to keep it easy and simple because there are a few mathematical equations we're going to be doing today, and I'm going to probably pull out a calculator here in a minute to kind of walk through what some of those scenarios look like. So I'm going to first start with an assumption. Let's say we have a office building in our community, and let's say it's a small office building, and that office building has 4 tenants in it. I mean, there's 4 spaces for different businesses to rent and pay a rent for. And we're going to make some assumptions. So we have an office building. And that office building has 4 tenants. And just for the ease of this conversation, I'm going to assume that all 4 of those tenants occupy the same amount of space within that building and they pay the exact same amount of rent per month. So let's just make it simple. That's probably not going to be the case going forward, but for this example, I just want to keep the numbers simple. So let's say each tenant pays $1,000 a month in rent. $1,000 a month in rent to you. So as the owner of the building, and we're going to assume this, and I always want you to approach a property investment as if you were the owner of the building, and that's what we're going to make these assumptions for today. Each of those 4 tenants pay us $1,000 a month in rent, so times 4. Collectively, they spend and give you, as the owner, $4,000 a month in rent. Okay. After a year, so we're going to take that times 12. After 12 months out of the year, on an annual basis, or at the end of the year, you will have earned from income from your tenants $48,000. Excuse me, $48,000. All right, pretty good money, huh? But that's not the end of the story because there are expenses that come out of that. And that's where I think we need to get into the weeds a little bit. So within commercial spaces or honestly within residential spaces, let's say this example, you buy a 4-plex there are apartments or townhomes or duplexes or a single family house. You can apply the same concept to that too. But in this example, I'm going to use an office building, 4 tenants, paying $1,000 a month. We have $4,000 a month in income or $48,000 per year. This number is what we called your gross income because this is before any expenses come out. So this is what you make before expenses. So let's talk about expenses for a minute. So I'm going to go back here, make some assumptions. So your gross income for the year on this example, $48,000. My marker cooperates with me here. $48,000 gross income for the year, per year. Okay, let's talk about expenses. And these are some things, when you were analyzing a property for this, if the property is a listed property and is advertised for sale, the owner or the seller or the seller's agent should have this information for you. If they don't, you can ask them, or you can probably make some assumptions, and I'm gonna kind of show you how to get there. One of the biggest expenses you'll probably have on the property is property taxes. So property taxes. And those will be determined by the county and what the property is located in. Many times you can go to a county website and pull up property details that'll actually show you what the property taxes are for that current year. Now, property taxes are always paid in arrears, which means you pay after you've assessed it for that year. And usually they're paid every 6 months or on an annual basis. But let's assume, for this example, property taxes for the year are $5,000. $5,000. You also are going to have property insurance. So insurance, and this is just insurance like you would insure your home. And let's say that is $2,000 on an annual basis. Now, once you become an owner, you will have to insure the building yourself. Most title companies, when you close on a property, and they're the ones that transfer all the paperwork for you and file the deed, will require you to have proof of insurance. A great way to check on that, if you don't know what the insurance is for that particular property, connect with a good insurance agent and say, hey, listen, I'm looking at this property. They'll probably ask you some questions: age of the property, what's the condition, what's the structure, what are we talking about here? They might be able to give you a good ballpark. But for this example, we're going to use $2,000 per year. Another expense, utilities. Now, this is where we have to go back and take a look at the lease. So each of those 4 tenants in this office building, they pay $4,000 total a month in rent. But what else do they pay? Do they pay a portion of utilities? Do they pay a portion of property taxes and insurance and things like that? Sometimes they do. And that's where the way the lease is written will tell you exactly what those tenants are responsible for and what you as a landlord are responsible for. For this example, I'm going to assume that the landlord pays everything, meaning the landlord pays for the taxes, the insurance, and the utilities. And in this particular example, that would mean that the type of lease is called a full service lease. So that tenant writes one check every month. They don't have a separate utility bill. Now, granted, they might have to pay for internet and phone, but I'm talking water, gas, electric, trash, sewer services from your city that you live in or that the building is located in. So let's assume for this that all the tenant pays is just their monthly rent and everything else is wrapped up in there. So let's say utilities for the building, they might run you $6,000 a year. Again, these are just examples. I think I may switch markers here. I think my marker is kind of leaving me out here. Okay, property taxes, insurance, utilities. What else? What else is there? There may be lawn care or snow removal, depending on the part of the country you live in. Now, you might not have this, depending on where the office building is located. But you might also not have snow removal, depending if the building has a parking lot. Or those things might be on the tenant. Again, we need to go back to the lease and see what that means. But these are items to be thinking about. And the name of the game here is that we need to get down to a net number. We need to figure out what are the expenses for the building, deduct it from our income, and then we're going to get a number. We're going to get there here in a second. So lawn care or snow removal, and maybe that runs $1,000 a year. Okay, what else? Maintenance. Now, if the property is listed and if the owner has kept good records, I hope they have. And when you become an owner in an investment piece of real estate, please keep good records, keep receipts, keep a log. Because for one thing, on your taxes, that helps you show deductions and it helps you depreciate the asset. That's a conversation you need to have with your CPA. But these are some things for an accounting purpose and documentation purpose that are very, very important, especially if after you acquire the asset, sometime in the future, you might decide to sell. And having accurate records on what the true expenses are very important. So maintenance is something that you should account for. Maintenance is not always a set number. It might mean that maintenance last year was a little higher because maybe there were some roof repairs. Maybe the parking lot had to get resurfaced. Maybe they had to replace an HVAC system, or maybe something smaller. They had to do some paint touch up or carpet replacement, things like that. For this assumption, I'm going to say the maintenance on the property for the past year was $5,000. Okay, the one thing we're not going to include in our expenses is any loan payment that exists or that we would have. That is a completely different line item, and that's what we call debt service. So if you're a homeowner already, you're probably familiar with making a mortgage payment. So those are the things we're not going to include in our expenses. We're going to make an assumption because sometimes people buy properties with cash, and we want to make an analysis based on that philosophy. But this is also important. I'm going to get to a bottom number, and then I'm going to show you how it works into a loan payment and what type of loan payment you should go after to see if the property makes sense. And so that's what we're all about, because I'm all for literally using other people's money, like a bank or a credit union or a financial institution, using other people's money to acquire assets that provide you with passive income. And that's what a lot of investors do. So for this example, I'm going to keep it pretty simple. I'm going to use property taxes, insurance, utilities, lawn care or snow removal, and maintenance costs as our example. I'm going to add one more thing, and that's management. Management, whether or not you manage the property yourself or you hire it out to a management firm, it's interesting to keep this as a line item and as expense for a couple of reasons. One is the tax deduction. So even if you are self-managing your property, allocating funds for that management is important because you can work that back into your favor for deductions. So I'm going to say management on this property runs $3,000 a year. If you are acquiring an asset where you have no desire to take on the management, you can sure hire out those management activities. And there's probably management companies within your community you can get estimates from to understand what they charge for this and what their management fee includes. Is it just accounting and collecting rents? Is it leasing activities? Is it doing maintenance? Is it coordinating that? There's a variety of things you can go after. So let's do some math, and let me grab my calculator real fast. As I do some math here, okay, so our property taxes are $5,000. Our insurance is $2,000. Our utilities are $6,000. Our lawn care and snow removal is $1,000. Our maintenance, $5,000. And our management fee estimate, $3,000. That gives us $22,000 per year in expenses, total expenses. Okay, so remember, our income's $48,000. Our expenses are $22,000. So we're going to do a quick math. We're going to subtract our expenses from our income, and we get $26,000 is our net operating income. Another word is an NOI, which is an acronym for net operating income. This is the number you need to focus on. What is your net operating income after you've collected all your income, after you've paid all your expenses? What's your bottom line? What goes into your pocket? And it's that number right there, $26,000, an example for this property. So I know we're not doing an interactive course right now, but I would love if you want to reach out to me, whether you DM me or shoot me an email. I hope this makes sense for you. I'm happy to kind of go into further detail, but this is a great basic way to figure out how a building or an investment property performs. It's not the $48,000 a year. That's what you collect in rents. You need to deduct the expenses and get to that bottom number, that net operating expense. In this case, it's $26,000. All right, so now how does that fit into our total investment strategy? I'm going to erase all this. So back to our office building with 4 tenants. We make $26,000 a year. $26,000 NOI. Remember, net operating income. And my marker, I apologize if you can see this. That's why I'm speaking it to you as well. Net operating income, $26,000. Okay, now we get down to purchase price. And this is where it gets a little bit tricky So this only makes sense, making $26,000 a year on a building, if we can buy it right. And here's the thing, there is no perfect answer for this. There is no perfect price, but what might be perfect is what you're comfortable with. Some investors have a very different risk tolerance than others. I know, me not owning a lot of commercial property, but working a lot in commercial property, my risk tolerance might be a little different than yours. If you're just getting into this, you might take a more conservative approach, which is just fine. So for this example, I'm gonna say that the price of this building is on the market for $300,000. $300,000. And you're like, okay, but how do we know if that's a good deal? So we're gonna do a quick equation. We're gonna take, and this is where we get into something called a cap rate, which is a capitalization rate. We wanna see how the building performs. And when we get into a conversation about commercial lending, and I just recorded an episode with a commercial lender, we're gonna go into the weeds a little bit on that. What's a good cap rate? But I want you to understand it so you can do some quick math. Take your income, take your expenses, get to your net operating income, do a quick math equation by the purchase price or what you think you can get it purchased for, and figure out what that cap rate is. So in this instance, we have $26,000 a year in net operating income. We divide that by $300,000, and we get a number, and it's a percentage. In this instance, our cap rate is 8.7%. And you're like, okay, what does that mean? So here's something that took me a little bit when I first got into real estate to really understand how the numbers worked. The higher the cap rate, the lower the price. The lower the cap rate, the higher the price, which is interesting. So in my opinion, an 8.7% cap rate is actually a pretty good place to be. Why I say that, and that's where we come into lending. So we are at the beginning of 2023, and interest rates have been creeping up for all of us, whether we're buying a house or a building or a car or a credit card, you name it. In the commercial lending world right now, interest rates are hovering around 7%. Are around 7%. Where I want to see you analyze a building, if you have to get a loan, and many of us do, and actually I encourage it, it's a great relationship to have and a great resource for your money. But at 7%, that's what you'll have to pay in interest to, get a loan for the money to buy the building. You're making 8.7. So that's kind of your yield. That's the difference between the two. What I don't want to see, and again, you'll have to judge where you're at financially and what makes sense. And that's a different conversation altogether. We're kind of using some basics right now. If this cap rate were less than 7%, let's say it was 6%, your yield just got negative. So you're paying more for the building by virtue of your interest rate than what you're actually earning. Now, there are some ways to get around this. So if we go back to the tenants and we go back to the physical building, this is where you get to analyze, okay, are those tenants really paying a market rent? The $1,000 a month they're paying, is there an escalation clause in their lease? Over time, does their rent go up? Can I come in and take a look at the building and decide, okay, if I make some improvements, meaning maybe I replace paint and carpet and trim and make some modifications that justifies a higher lease rate, could my tenants pay it first and foremost? Is it in line with what the market commands? And will that increase my net operating income? That's the name of the game. Anytime I look at an investment, I want to look at status quo. What is the existing environment? Meaning what kind of income's coming in? What is my tenant mix? What are they capable of? And what improvements, first and foremost, have to be made? Because maybe there was some deferred maintenance. And second of all, what improvements could I make? And what's the cost of that? How much money could I have to, or would I have to put into the property to get a higher rate of return that would justify an interest rate and a total yield? I hope that makes sense to you as I'm explaining it that way. And again, if you're listening to me only online, jump onto YouTube and I can show you an example right here. But from a very elementary aspect, using this equation, looking at income, looking at expenses, finding out your net operating income, dividing it by the purchase price, to figure out what makes sense for you from a cap rate perspective. Now, there are some properties out there that trade, meaning they sell at a much lower cap rate, which means their purchase price is a lot higher up. Cap rates are interesting. I mean, yes, we get to them by a mathematical equation, which is net operating income divided by the purchase price, and we get the percentage. Now, there's something in there that cap rates can't tell us numerically, but they can also help give us a little more sense of security. It could be the strength of the tenant. For example, a Starbucks that's a tenant in a building will probably have a much longer lease than somebody that's a local office user. Starbucks, quite frankly, might have a 10, 15, 20-year lease, so they're solid. From a company standpoint, to my knowledge, they're not filing for bankruptcy anytime soon, so they're a pretty solid, credit-worthy tenant, so they're gonna pay their bills on time. Depending on how their leases are structured, they might also cover all expenses. So for the most part, depending on the building they occupy and the deal you're looking at, that might be a tenant to have in an investment where you don't have to do anything. You don't have to maintain it. You don't have to manage it. That's all taken care of by the tenant. Because of that, their cap rate, if you look at an investment like that, might be 5% or 4%, depending on the market and depending on what they're paying. Now you might say, whoa, that's not for me because my loan isn't in the 4 or 5% range. But depending on the type of investor you are, you might like that type of risk because you have a longer term strategy. So when interest rates, level off or maybe come down a little bit, you have the opportunity to refinance, you have a solid tenant, and maybe you have an asset that will continue to appreciate over time. So there's lots of elements that go into this, but I wanted today just give you some basics for how to start investing in real estate. If you want to connect with me more to kind of take a deeper dive into what that means, or if you want to work with me to locate and identify commercial real estate opportunities, then jump on my website, KirstenFlory.com, and my company is FoundationsCommercial.com.